Hello, everyone. Today on the final bar, we're joined by Jay Soloff from Investors Alley, giving us a little talk about volatility, focusing on the options market. Overall, with equities, we've seen certainly a resilience in the through the course of the day. Bit of a distribution coming out of the open, so into the late morning, it felt like weaker rather than stronger. But then stocks really pushing to the upside. News from Apple and that a stock like that being up 3 or 4% is certainly going to move things higher. But it was things like utilities, energy, materials at the top of the list. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together. Are you having fun yet this week with one distribution day followed by one accumulation day? It was sort of one day to the next, completely different in terms of the characteristics of the day, in terms of how they felt, in terms of the dynamics of leadership and laggardship. Yesterday I felt like we were rotating into this new, sort of mean reversion discussion where technology is back on top. Things like energy, financials sort of take a breather. That was a short-term experiment because today we're sort of back to some of the leadership themes that we've seen before, particularly with energy rebounding nicely off of yesterday's distribution, but utilities number 2, materials number 3, real estate number 4. So it wasn't the juice, quote unquote, leading us higher. Some of the more defensive parts of the market. It's interesting. If on a day like this, it would be interesting to take Apple out of the picture and see what the market does without that influence. But certainly, a rising tide lifts all ships or lifts all boats, and you can see how things sort of bubble to the upside today. We'll talk about all these different movements. I think the movement in gold today and precious metals is another interesting one, especially if you think about gold as a safe haven. You're missing days like today where they move up in concert. We have some fantastic guests on the show. I'm so appreciative this year and especially recently the quality of guests we've been able to bring on. We have Jay Soloff joining us from Investors Alley today for the first time. Excited to hear from Jay. Tomorrow we have Tony Dwyer from Canaccord Genuity, one of my favorite macro strategists, to come and share his take about the year end into the new year. And then on Thursday, we have Dr. Alan Ellman from the Blue Collar Investor joining us for the first time. On Friday, we'll do our normal routine, wrapping the week, looking at the key themes of the week. And then starting next week, just so you guys know, the next 2 weeks we'll actually be taking off live programming on the final bar and on much of StockCharts TV as we all sort of wrap up the year. We're going to transition in of sorts to some fantastic special programming for year end called Reflections 2020. We have 3 buckets of content coming your way. One set of 10 specials with 10 strategists sharing their chart of the year, their top technical theme. We have a separate set of discussions on year-end reviews and how you go through and evaluate your performance, set yourself up for success next year. And then a third series of videos, interviews with Julius de Kempener and others talking about sector rotation and doing some deep dives on some particular sectors. This is it's sort of a different approach to our year-end programming that we're really excited to put together. It's been fascinating talking with all of the experts that we have, Gaddis Rose, Keith Fitzgerald, and many others, and sort of getting their content. And we'll start rolling it out for you this coming Monday. Wanted to get to our market recap. Wanted to start with a poll we did recently. As you probably know, on stockcharts.com/TV, we always have a poll running. Also on our YouTube channel, we do as well. We asked you, how often do you use point and figure charts? Gave you 4 choices: every day, a couple times a week, a couple times a month, or what's a point and figure chart? And that was by far the most responded answer. The strongest response was for what's a point and figure chart. About 38% of you said that. 24% of you said a couple times a month, and that's honestly where I about net out. There was a time earlier in my career where I used them every day, and I would have been in that first bucket. And at times I've regretted that I've gotten away from it. If you don't know point and figure charts, if you're part of that group that said you're not familiar with them, I would encourage you to explore them a bit. We have a fantastic point and figure engine on StockCharts .com. Our chart school pages can explain to you some of the signals you'll be looking at and different ways to interpret the data, but it's really, really well done. I think there's a lot of, sometimes it's not as well designed depending on the site. And I think StockCharts has done a pretty good job of designing it. And what it's designed to do is take the noise out of the picture. I learned point and figure charting when I was studying for the CMT exam and read some of the classic, sort of introductory books, and then got to know Jeremy Duplessis, who's a point and figure expert, and learned some of his techniques that he has used. And then when I was, occasionally going to places like the CME in Chicago and talking with floor traders, I talked to some guys that were using, trading NASDAQ futures just using point and figure charts. And it is a great way to take the noise out and focus just on the trend. So if that's something you find yourself looking to do, maybe worth exploring a little bit. Let's continue on with our market recap here. So the S&P is certainly finishing stronger, getting back toward that 3,700 level, but not quite getting there, but up about 1.33%, which is pretty impressive, just below 36.95. Mid caps and small caps pushing higher. So small caps were really the leadership. If you look at the day from yesterday to today, just look at it, just took off and just continued to push higher through the entire course of the day. It was one of the things coming out of the open. You saw large caps kind of coming off to 11 a.m. You saw small caps just driving higher, and that was one of the things that certainly felt like we had potential for much further upside today. So small caps up the most, about 2.6%. NASDAQ 100 lagging behind a little bit, with technology essentially middle of the road of the 11 S&P sectors. Bonds off just a bit, with 10-year yields around 92 basis points at the end of the day. In the commodity space, pretty good overall. Everything was up from a little bit to a lot, and gold and silver were certainly appreciating. So that chart of the GLD is an interesting one. When you look at a chart of the gold future, or we'll look at the GLD here, it's essentially been choppy. You could argue we made a lower low into end of November. We've now rebounded, and now we've potentially made a higher low. If you assume that today is the beginning of a bit of a recovery, I think getting back above the 50-day moving average, getting back above that high from about a week ago would be a nice sort of transition from distribution to accumulation, might signal further strength in gold. A lot of people, I was talking to one of my friends who's in more of an asset allocation space this morning, and a lot of times we oversimplify and think of gold as a safe haven versus stocks versus risk assets. And remember, a day like today hopefully helps you dispel that myth. It is not a one-to-one. There is not a perfect inverse correlation between something like stocks and something like gold. There are plenty of times where they move against each other, and there are plenty of times I can show you where they move together. A day like today sort of shows you how that relationship can be very similar. So both gold and stocks having a pretty decent day and sort of bouncing off them. So if you take anything away from those comments, I would encourage you to focus less on what should happen based on your understanding of a relationship. Focus on what actually is happening. The reason why something like stocks and gold can rally at the same time usually make a lot of sense down the road a bit. In the rearview mirror, it'll make sense why things were moving certain ways. But in the short term, focus on what actually is happening. And the message you're getting is weaker dollar, stronger metals, stronger stocks, essentially weaker bonds. That's sort of the way I would describe things overall, and stronger commodities overall for sure. Let's continue on with our market recap here. Look at the chart of the S&P 500. So, not a ton of change. And while I feel like at times it's very easy to sort of live or die by the daily movements, I would encourage you to look at a longer point of view. There's a reason why we always have a 1-year chart to put today's movement into proper context. This is one, just brief moment along many, many moments that make up a long-term trajectory for equities. Overall, the trend is undeniably positive. We've seen that from our long-term trend following model, all positive on its different timeframes. And overall, what you're seeing now with stocks is just, essentially not a dramatic move higher. It's not accelerating like you saw the first week in November, but it's just sort of, it's sort of like a plane. If you ever looked at what actually happens when you fly an airplane, you have to put a lot of power to get off of the ground, and then you sort of lighten it up a little bit, and you have a nice slow and steady gain of altitude, which cuts down on noise and taxes the engine a little less. You use as much as you need to get off. That's kind of what happened here. We took off for the first week in November, and from there was sort of a nice increase in altitude as we continue higher, but it is an increase. The question now is, can we power above 3,700? We're teasing it once again. We tried a couple times here over the last 2 weeks, have not really been able to close above there meaningfully. Now, what has actually gotten us to this point where there's a lot of things to look at, certainly, but The chart of Apple is one place I would focus on a bit. This chart, if you look at the FANG stocks, they're not great. If you look at the average FANG stock, it's sort of middle to down, right? Netflix is sort of in the middle of its range for the last 3 months. Alphabet maybe is the other one that's already broken above its highs from earlier in the year, but the rest are sort of in the middle. Microsoft sort of in the middle, Facebook and so forth. Apple is maybe the second one starting to show signs of life, and obviously some news this morning that caused a jump higher. But I like the follow through, up about 5% today, breaking above its October peak. This is where it hit a peak last week, and now pushing higher. Obviously, the big level is here from early September. The question is, do we get back up here and then what? Right? Are we able to power through that and push to new highs? But overall, this is one of those mega cap tech consumer communications names, for now resolving to the upside. After a day like today, you hear me often talk about follow through, and I'd be very interested to see tomorrow through the remainder of this week whether you're able to follow through on today's gain. Once you digest what happened here, do investors push it a little higher, keep it above 125? And if so, that would be the first line in the sand I'd be looking for to see if that's able to hold. Below there, you have around 120, which is the swing low from end of last week. But overall, a mega cap name like this, a huge benchmark name for money managers accelerating to the upside like this, what it does is it reminds you how important it is to own a name like Apple. And even with all the movement, overall, it's not been a bad name over the long term, outperforming the S&P by 58% or so over the last year. So not a bad long-term trajectory. We need to take a quick break. We'll be back with my guest, Jay Soloff. We'll see you in a minute. Hello, everyone. Welcome back to the show. Thanks for joining us every weekday after the close for the Final Bar. I'm your host, Dave Keller. I appreciate you joining us as always. We're going to do another mailbag segment a little later in today's show. As a reminder, we love to hear from you. Feedback on the show, feedback on your host, on our guests, but especially questions that come up as you go through the process of trading, investing, analyzing the charts. How can we help point you in the right direction? Shoot us an email, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment @finalbarsctv, or on our YouTube channel, just put a comment right below the video you're watching. We'll capture all of those and hope to answer one of your questions in our next mailbag segment at the end of this week. I want to welcome on my guest joining us for the first time, Jay Soloff. Jay's the lead options analyst at Investors Alley, joining us from the Phoenix area. Jay, welcome to the show.
Thanks, Dave. Thanks for having me.
So I appreciate you focusing a bit on volatility. Obviously, this is the difference in the volatility regime from last year to this year has been, severe. And I think a lot of people have been struggling to make sense of all of it. You're starting with the VXX, one of the few, the VIX ETNs. Start us here. Where are you looking here?
Yeah, sure. Well, for option trading, it's really exploded this year at, the open interest and the amount of volume has been insane. And a lot of that really is driven by volatility, particularly, you see this sort of action when the markets are more volatile. You see generally a lot less options action in the more quiet years. So this has been a huge year for volatility, a huge year for option trading. And I think a lot of people, they might have heard of the VIX because it's pretty commonly quoted and it's a common gauge of market volatility. But I don't know if everyone really realizes that it's not in itself, it's not tradable. It's a calculation. In order to trade it, you need to trade products based off the VIX futures. The most popular one right now is VXX, and sometimes it changes a little bit. There are some levered products out there, and some new things being added, some things being taken away. But generally speaking, VXX is the most heavily traded of these ETNs, and it's a short-term volatility product. So it just covers the first two futures of VIX. And what's interesting about it is that it moves a lot, right? It can move in large chunks, but in many ways, it's also predictable, right? So Now, obviously, here's the March crash. That was not predictable in the sense of, you never know when a crash is coming. And one of the things that really exacerbated this crash was the liquidation of volatility funds that were caught on the short volatility side. So that sort of thing you can't always predict. But you can see, though, that we also had, a high amount of volatility towards the end of 2018, beginning in 2019. And you can see this pattern here of volatility spiking and then it slowly sort of grinding lower. And, that tends to be the case. Volatility tends to cluster and then mean revert. And so what we saw this year was volatility kind of remaining higher as we headed into the presidential election. But then after that, short-term volatility took a nosedive. Now, you can see here, not maybe as extreme as it might have been because of the pandemic, but you did see this certain sell-off after the election. And that was despite knowing that there was going to be issues potentially with the transition and also with the pandemic continuing, in fact, getting worse. So that's one way of looking at volatility. The other way is the VIX, again, it's based off the future. So this is a short term. You can also trade further down the futures curve. It's just like a treasury yield. There's a term structure to volatility. So the back part, actually more of the midterm, so the 4th through 7th month, you could trade. It's not as liquid, but you could certainly trade it, and trades well enough that you can certainly get in out positions, no problem. And that's VXZ. And so the difference here, as you can see, is that the mid part of the curve has stayed relatively stable. It definitely sold off during the presidential election, but not nearly to the extent as short term. And that is, essentially because the back months are still looking at the potential volatility of the fallout from the pandemic and also from the Senate runoff, right? There could be some sort of difference in market opinion if they think taxes are going to be a lot higher, or regulations may be a lot higher. But I still think ultimately, though, people are looking at the pandemic and its impact on the economy. So one thing you could potentially do to trade the situation is, you see VXX, that will probably drop no matter what after the Georgia Senate runoff, unless something really crazy happens, right? So even if let's say Democrats take Congress, it'll still probably sell off to some extent because the known unknown is now out of the way. But you could bet that VXE will probably remain elevated for, probably until the pandemic looks like it's going to be free and clear. So sort of a hedged trade might be buying a put or shorting VXX while buying a call or going long VXE, sort of a way to hedge yourself while also taking advantage of the shape of the VIX term structure.
It's a fascinating way of thinking about volatility. And again, I probably look at it oversimplistically because I'm looking at the VIX and just a couple basic indicators. I hadn't thought about the term structure, really thinking of short term versus medium term. I'm curious what would you see that would cause this idea of the short term volatility coming off, the medium term volatility remaining high. What would cause that to break? What would cause that to not play out? Would it be some sort of surprise, in Georgia or something like that? I mean, how would you sort of think of that?
Yeah, I think a combination of, maybe a mixed government. So if Republicans hold on to Senate, so there's not going to be a lot of, regulatory or congressional changes. If you have that paired with extreme immediate success from the vaccine, you might just see a complete crash of that curve, right? It might,
Right.
I don't think we're going back to 2017 levels anytime soon, but we could see that whole curve, drop below the 20 level that it's been for essentially the whole year. So something like that. But I really don't expect that. I kind of expect it to remain elevated through spring until, we actually see longer term results of the vaccine.
It seems to me, Jay, certainty is one thing I don't feel like we're going to have in our pocket anytime soon, given how things
Completely
have gone
agree.
up until this moment. But I would love to be surprised by something a little more certain. This has been fantastic, Jay. Thanks for walking us through this. I know this is an area that I think many of our viewers are less familiar with, and I really appreciate you going through some of the details. Jay Soloff from Investors Alley, appreciate you joining us, and have a great holiday, okay?
You too. Thank you.
That's Jay Soloff. Jay's the lead options analyst at Investors Alley, coming to us from the Phoenix area. I really, again, I'm always so appreciative to talk to guys like Jay who do a portion of the market or approach it in a way that I'm less familiar with. It's not something that I do, day to day, because I have gained the most, I think, over my career from working with people and meeting people and talking with people who are looking at a different time frame, a different asset class, a different, we're trying to answer a different question, because a lot of times there's similarities you probably wouldn't identify. We're all trying to anticipate turning points and understand trends and, think about how events are going to potentially impact the trajectory of different asset classes. So really appreciate Jay's thoughts there. We need to continue on. Our next segment is the Final Bar Mailbag. As I mentioned, we love hearing from you. We've received so many really, really thoughtful questions, and I appreciate many of you are giving me a lot of detail in terms of what you're looking at. We'll do our best to answer as many as we can. We'll do another mailbag segment. If we don't get to your question today, we'll do one at the end of the week. So please keep your questions coming. Question number 1, thank you for the Final Bar every day. How come the sentiment and breadth indicators are never updated with the latest day's data? Even the AAII bull bear data, which is updated on Thursday, isn't up to date at the end of the Friday show. Oh, interesting. Not having daily data, up to date daily data makes it a little more difficult. Appreciate the question, and that's a miss. So if it looked like things weren't updated, something like the AAII data does come out every Thursday, so that probably was a glitch or something. If you saw that, I'd encourage you to hit our support desk and send them a note if you're not seeing an update. And to be honest with you, it all depends on the particular data that you're looking at. Some of them, and it's how we're actually capturing the data. So if I'm looking at stocks that are advancing and declining, that is something StockCharts is able to calculate all during the day. So we're able to have a live number showing you that. And so you can see 79% of the the New York Stock Exchange advancing today versus declining. Some of the breadth measures like cumulative advanced decline lines, we actually calculate after the end of the day. So we have to wait a little bit to process all the closing prices and make sure that we're going to put accurate data out there. Other stuff isn't updated till end of the day, so you actually see it the next morning. It all just depends on how we're able to acquire that data. I would encourage you, if you're not clear on what on when things were updated, I would lob a question into our support desk. I would tell you one thing to certainly pay attention to, looking at like the AAII data. You can see at the bottom, it'll show you when it was updated, especially if it was not updated. You're not seeing it on here, but on the if I gave you the longer description, it'll tell you the date of when it was most recently updated. These actually show you last week's reading for this week until the new data comes out, just so you have the most recent reading with the current price bar. But thanks so much for that question. Let's see. Excellent illustration of the OIH. Besides the RSI divergence, I also see a golden cross. In your experience, which prevails? Boy, great question. I think you're talking about, I showed recently on the show the price going higher and the bearish divergence, and this is what you're talking about, the golden cross here. So which prevails? So you will hear me very rarely refer to the golden cross for any reason on the show, and the death cross or the dead cross, which is when the 50 crosses down through the 200-day. And that's because of my own experience. If you test that over the long periods of time, there are some long-term cyclical trends where that actually is a positive strategy, but I've not found it to be an incredibly valuable strategy because it tends to lag pretty far behind. I've much better things, I think, to track uptrends and downtrends in that. So given the choice here and the fact that a golden cross just happened and it's a bearish divergence, that for me is much more of a warning sign than this is a bullish sign telling you that the trend is going to go up a lot from here. What that does, it tells you until now the trend has actually been pretty positive, but a lot of times in a choppier market, that's right about when things start to turn down is when that sort of thing happens. Thanks for asking that question. I will tell you, going on financial media, they love anytime there's a golden cross. I'm often asked about it, and I usually try to punt on responding to that as much as possible. I'm just not a huge fan of it. Next question, a couple of basic questions. Great. I want all of my charts to open up with Heiken Ashi charts. That's great. I save it as a default, but then the charts still open with StockCharts Classic view. I then have to select default, which defeats my intent. So what you're trying to do is set a new default charts out. So when I type a symbol like UNH for United Healthcare, I see this is my default chart. And what I did to do that is I created a chart style called like SCTV Daily, which is what I like to refer to. And then I clicked on Save as Default. So if I wanted to create, let's see, make this a Heiken Ashi chart, which is this one, which if you've not used them, boy, I'd encourage you to look at them. They're actually really fantastic for understanding trend characteristics, how they've done. Then you say add new, and you say Dave is good, and then you hit add. So that'll make it a new chart style. Then all you need to do is say save as default and say okay, and then I'll do that. And then when you type AT&T, it should give me Heikinashi with all these. So that's sort of how it should work. So make sure you save a new, add a new chart style with however you want it to look, and then click on Save as Default. If that doesn't work for you, ping our support desk. They can give you an idea. The second one, just very briefly, because we're running out of time, I annotate things with a horizontal bar. So again, sorry, this chart isn't, it's just sort of a random chart. But you said you often go in here and you set a horizontal line, and this is like on a fundamental valuation. I often put these on here for entry and exit points. So if I buy a position on something, I'll put a horizontal line at that price level so I can just track it. And your point was, I don't like having to go in there and, I don't like to go in there and have to, adjust the line and come up with a particular price level. So here's the trick. Down here below the chart, there's a section called overlays. And if you click on that, there's an indicator called horizontal line, and just put in a value. So if I say 110 and say update, it's gonna, well, of course, that's a horrible idea, sorry. The stock's trading at like 31, Dave, come on. 31, so there we go. So now I have a horizontal line right at 31 exactly. So if you have a particular level, that's a much more a better way to be precise. Otherwise, you're doing it visually, which you're welcome to do either. It doesn't matter to us, obviously, which way you do it. Well, we're out of time, but I'll do one more question. Could that OXY candle pattern be a version of the inside down pattern? You got it, and you're absolutely right. This was the thing I actually posted on the show, and I believe, knowing your Twitter handle, I believe you're just going through the CMT exam, so congrats, and I wish you the best on that. This is Heikinashi chart, so let's go to a regular. I messed up my whole default chart, for the good of the show. You were looking at this one. Yeah, the up bar, the little candle, and then the down bar. The down candle, you're absolutely right. It is. It's a, an inside down pattern, or you call it a bearish inside down. A lot of times you look for the bar to be a little higher, but I think this still counts. I think that's valid. Great call. Inside down pattern. Well done. Or they call it a 3-bar inside, 3 inside down, I think you call it. Well done. Good job. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the chart of Apple. We talked about this earlier. And again, I'm interested when I see a mega cap stock like this break out of resistance, break below support, because I will tell you there are many institutions that need to be on the right side of Apple. If you're running a fund and your benchmark is the S&P, you really need to be on the right side of Apple. And I think moves like this tell me that you probably want to own it rather than anything else, because if you miss out on something like this, it's a huge drag on performance to try to dig out of. So overall, that's encouraging for the stock, but it's also encouraging for the market as a whole. Stock like Apple doing well from here. I think 125 now, is it able to hold that? Do we get follow through in the next couple of days? I think that would be key. And if we do pull back, 120 would be that most recent swing low, the 50-day moving average, not too far below. Chart number 2 is looking at the breadth in the form of the cumulative advanced decline lines. And I'm bringing this up just to point out, you can see just as we're recording the show, some of these are updating because we're processing the end of the day reads on things. But overall, I would encourage you, especially when I saw these things turn down. I saw a comment somewhere about the breadth turning negative yesterday, and I'd be very cautious about doing that sort of thing. There's a reason why we're looking at 1 year and we're zooming back. This is a long-term trajectory. You want to be looking at the trend in these indicators, just like you'd look at the trend in the price. You can look at advanced or decliners day to day, but I would just be looking at the daily read for that. If you're using this, you should be looking at the longer-term trend. Don't worry today too much about one day or one move. Think about the long-term trend. Finally, semiconductors. I think the strength in Apple is showing you the resilience in technology as a whole, but the relative strength of semiconductors more than anything should impress you. And again, whether or not you are bullish or bearish on stocks through year end or stocks into next year or whatever, or you're bearish on all of it for all of the above, something like this that is outperforming in a bull phase and outperforming in a bear phase is the kind of thing that I would want to participate in. I think of that as more of a core holding, something that you can build things around because it's working regardless of whether or not the market as a whole is working. Folks, that's our show for today. Thanks so much for joining us. I want to thank Jay Soloff from Investors Alley for joining us from Phoenix, giving us a nice take on the volatility regime. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.